Module 9 to 1 P/E ratio and dividend stocks. The P/E ratio, or price-to-earnings ratio, has several implications for dividend-paying stocks. Here are some key considerations. Dividend yield. The P/E ratio provides insights into the relationship between the stock price and the company's earnings. Dividend yield is calculated by dividing the annual dividend per share by the stock price. A lower P/E ratio generally implies a higher dividend yield, as the stock price is lower relative to earnings. Investors seeking higher dividend yields may find stocks with lower P/E ratios more attractive. Dividend sustainability. The P/E ratio can indicate the sustainability of a company's dividend payments. A low P/E ratio suggests that the company's earnings are relatively high compared to the stock price, indicating a higher likelihood of sustainable dividends. However, a high P/E ratio may raise concerns about the company's ability to sustain its dividend payments, as it suggests that earnings may not be sufficient to support the stock price. Dividend growth potential. The P/E ratio can also provide insights into the potential for future dividend growth. A low P/E ratio indicates that the company has more room for earnings growth, which can translate into increased dividend payments over time. Investors seeking dividend growth opportunities may consider stocks with low P/E ratios, as they suggest potential for higher future dividends. Market sentiment. The P/E ratio reflects market sentiment and expectations about a company's future earnings and dividends. A high P/E ratio suggests that investors have higher growth expectations and are willing to pay a premium for the stock, which may reflect positive market sentiment. Conversely, a low P/E ratio may indicate lower growth expectations or concerns about the company's performance, resulting in a more cautious market sentiment. Risk assessment. The P/E ratio can be used as a gauge of risk associated with dividend-paying stocks. A high P/E ratio may suggest higher valuation and increased risk, as investors are paying a premium for the stock's expected earnings and dividends. Conversely, a low P/E ratio may indicate a lower valuation and potentially lower risk, although it's important to evaluate the underlying reasons for the low valuation. Income generation. Dividend-paying stocks are often favored by income-oriented investors who rely on regular dividend payments. The P/E ratio helps assess the attractiveness of a dividend-paying stock based on its earnings and dividend potential. A favorable P/E ratio, indicating a reasonable valuation relative to earnings, can make the stock more appealing for income generation purposes. It's important to note that the P/E ratio should not be the sole factor considered when evaluating dividend-paying stocks. Other factors, such as the company's financial health, dividend history, payout ratio, cash flow, and growth prospects, should also be taken into account. Conducting thorough fundamental analysis and considering the company's overall financial strength and ability to generate sustainable earnings and dividends is crucial when investing in dividend-paying stocks. Analyzing the P/E ratio in conjunction with dividend yield and payout ratios can provide valuable insights into a company's dividend policy and its attractiveness as an investment. Here's how you can analyze these metrics together. Evaluate the dividend yield. Dividend yield is calculated by dividing the annual dividend per share by the stock price. A higher dividend yield indicates a higher return on investment from dividends. Compare the dividend yield to the prevailing interest rates or the yields offered by other dividend-paying stocks in the same industry or sector. A higher dividend yield relative to comparable investments may indicate a potentially attractive investment opportunity. However, be cautious of excessively high dividend yields, as they could be a sign of financial distress or an unsustainable dividend policy. Assess the P/E ratio. The P/E ratio provides insights into the market's perception of a company's earnings and growth potential. A lower P/E ratio suggests that the stock is relatively undervalued or that the market has lower growth expectations. Compare the company's P/E ratio to its historical P/E ratio, as well as to industry peers or the broader market. A lower P/E ratio relative to historical averages or peers may indicate a potentially undervalued stock, while a higher P/E ratio may indicate higher growth expectations or an overvalued stock. Consider the reasons behind the P/E ratio and evaluate whether it aligns with the company's growth prospects. Examine the payout ratio. The payout ratio indicates the proportion of earnings that a company distributes as dividends. It is calculated by dividing the dividends per share by the earnings per share. A lower payout ratio suggests that the company retains more earnings for reinvestment or future dividend growth, while a higher payout ratio indicates that a larger portion of earnings is distributed as dividends. Evaluate the payout ratio in relation to the company's industry peers and its historical payout ratio. A sustainable payout ratio ensures that the company has sufficient earnings to support dividend payments and potential future growth. Consider dividend sustainability. Assess the company's ability to sustain its dividend payments over the long term. A combination of a reasonable P/E ratio, a healthy dividend yield, and a sustainable payout ratio is indicative of a company's ability to generate sufficient earnings to support its dividend policy. Look for consistent or growing earnings, positive cash flow, and a solid balance sheet. Evaluate the company's profitability, revenue growth, and management's commitment to dividend payments. Assess any potential risks that could impact the company's ability to maintain or increase dividends, such as changes in the industry landscape or economic conditions. Compare to industry averages. Compare the company's dividend yield, P/E ratio, and payout ratio to the industry averages. This allows you to assess how the company fares compared to its peers in terms of dividend attractiveness. If the company's metrics are significantly higher or lower than the industry averages, investigate the reasons behind the deviation. It could indicate that the company has unique characteristics or faces specific challenges that warrant further analysis. Remember that analyzing the P/E ratio, dividend yield, and payout ratio should be done in conjunction with a thorough analysis of the company's financial health, growth prospects, competitive position, and overall market conditions. These metrics provide a starting point for assessing a company's dividend policy, but a comprehensive evaluation requires a deeper understanding of the company's fundamentals and its ability to generate sustainable earnings and cash flow.